Joining us now is Eric Johnston, Cantor Fitzgerald's chief equity and macro strategist. Little non-consensus, Eric. What do you see in terms of the risk?
So we think the backdrop overall is favorable, and we're positive for the full year. But we think that within the first quarter, we're going to see a drawdown. And essentially the reason is for a few different reasons. One is that we've back tested when we've seen price performance like we've seen over the last 3 years. Our back test work says you've historically seen a drawdown in January or the first quarter. The second thing is that individual investor leverage has moved up sharply over the last 6 months. It's up about 26%. And when you include leverage ETFs plus margin balances divided by M2 to normalize it, it's at or close to a historic high. And then from a valuation perspective, free cash flow yield continues to fall. Right now it's at about 3.5%, which is a multi-decade low. And that not only matters for valuation purposes, but also from a buyback perspective. And then lastly, I would say, we are bullish on the capex, AI capex outlook for the year. But we do think there's going to be scares along the way. And because there's such high concentration risk in that theme for the S&P 500, there are many reasons where that could create scares along the way that could kind of initiate a drawdown.
But wait, I did just paint a picture of the growth that is set to pick up in the first quarter because some of the fiscal action, the tax legislation, a Fed that's been pretty easy, 3 cuts coming into the year and expected to do more this year. Fundamentally, feels like the market is in a good place. Earnings expectations are still pretty solid right now. These chip CEOs like AMD's Lisa Su are talking about how many yottaflops we'll need to build out AI. That's all bullish.
Absolutely, and I would agree with that. That's part of our view for the overall year is that you've got this very powerful combination of the fiscal stimulus you talked about. We think there'll be 3 cuts for the year. They're pumping $40 billion into the market, and this powerful capex, strong capex backdrop. But also keep in mind that this is not something that is unknown. There's been a lot of talk around the fiscal stimulus now for the last 3 or 4 months. The market's pricing in 2 cuts. We think there'll probably be 3, and the AI capex build out also quite known. So yes, we believe that's going to lead to mid-teens earnings growth, but we also know or think that it's not going to be a straight line, and because of those things, we think we're more susceptible than normal to a potential drawdown, which would be a viable in our view.